the S-REIT recovery window is officially open. After years of pressure, the tide in Singapore's finance sector is turning. By April 2026, the 3-month compounded SORA rate has collapsed to just 1.07%, a massive drop from last year's peak of 3.03%. Analysts at UOB forecast this rate to bottom out at 1% this quarter, creating a rare window for unit holders to see their DPUs soar. This isn't just a small dip, it's a structural shift in borrowing costs that directly impacts your investment returns. Most S-REITs hold 40 to 60% of their debt on floating rates. Every 50 basis point drop can save large REITs millions in interest. But the real gains are in refinancing. Fixed-rate tranches maturing now can be locked in at rates significantly lower than the 2024 hikes. The industrial sector is leading the charge. Take CapitaLand Ascenda's REIT, with its massive 39% gearing and healthy 5.8% yield. Or Mapletree Industrial Trust, yielding 6.2% and perfectly positioned to ride the high-tech industrial tailwind. Data centers are the standout performers. The explosion of AI infrastructure spending across Asia-Pacific is driving unprecedented demand. Keppel DC REIT remains a top pick, operating with a lean 37% gearing while capturing the global data workload surge. Even new players like NTT Global Data Center REIT saw their IPOs oversubscribed, proving investor appetite for this high-yield sector. Retail REITs like Fraser's Centrepoint Trust offer a defensive play, anchored by high-performing suburban malls like Causeway Point. With a 6.5% yield, FCT remains a favorite for stability, benefiting from consistent domestic consumption in Singapore's heartlands. However, the office sector remains mixed. Despite lower rates, hybrid work norms continue to pressure occupancy across older assets. For income investors, the yield spread has never looked better. While CPF ordinary account rates sit at 2.5%, quality S-REITs are yielding between 5.5% and 7.0%. The spread is at its widest point in several years. Even compared to the CPF special account's 4%, S-REITs provide a compelling 300-plus basis point premium for unit holders. But it's not without risks. In March 2026, the U.S. launched a Section 301 trade probe into Singapore, threatening new tariffs. While it doesn't hit REITs directly, any slowdown in global trade could impact logistics volumes and business confidence. The Singapore government is already responding with grants to help firms adapt, but investors must stay vigilant. The verdict for April 2026, the rate-driven tailwind, is more immediate and quantifiable than the distant trade risks. The recovery window is open, but it won't stay open forever. Rates are expected to drift back up by the end of the year. For diversified exposure, S-REIT ETFs like CSOP iEdge or Lion Phillip offer a way to capture the sector-wide recovery. The key is looking for REITs with near-term debt maturities who can lock in these record-low SORA rates right now. 2026 is shaping up to be the year of the S-REIT DPU recovery. The window is open, don't miss your chance. Subscribe for more deep dives into Singapore's financial landscape. This is the power of the SORA rate recovery.